I'd like to introduce our keynote speaker, Spencer Levy. He's the Senior Managing Director and Co-Head of Recovery and Restructuring Services at CBRE. But before I do, I'd just like to say a little anecdote. Last year we got Spencer on Fox Business News. I thought it was his first TV appearance, but it turns out it's actually his second. His first was on The Price is Right when he was in college. Apparently he blew a $10,000 jackpot over a $2 box of spaghetti. So just so you know a little bit about Spencer. So anyway, I'd like to just give you a few notes on his background. As Senior Managing Director in Capital Markets, Spencer is responsible for overseeing and coordinating the activities of more than 300 investment sales and debt equity finance professionals in the eastern region of the U.S. In addition to his duties in capital markets, Spencer is co-head of the Recovery and Restructuring Services business line. RRS, as it's called, serves both large financial institutions and government entities to assist with real estate services required for REO and whole loan assets. Prior to joining CBRE, Spencer was a principal at Stifel Nicolaus, formerly the Legg Mason Capital Markets. As principal there, he was responsible for leading overall execution on several major mergers and acquisitions. He played a significant role in his initial public offering of 6 REITs, as well as dozens of other public and private capital raising transactions. Previous to Stifel Nicolaus, Spencer was an assistant general counsel at Witkoff Group and practiced real estate at Fried Frank and Jones Day. So don't mess with him. He's an attorney too. So please welcome Spencer Levy.
Well, Ryan got the Price is Right story correct, and since I wasn't so good at getting a price of a 2-pound box of cream-ed spaghetti right then, hopefully my opinions on pricing have improved, since that's what we're going to be talking about today. But good morning, everybody, and it's great to be here again. Last year, I gave a speech similar to this at this very same event, and boy, I didn't think I'd be giving the same speech or something similar the very next year, but the market has been unusually uncertain over the last year, and I think it's been far less active than any one of us would have anticipated in terms of deal volume, capital flows, and how the whole overall restructuring market is working. But nevertheless, we are going to be talking about distressed real estate today again, and hopefully next year we can talk about a different topic, though I think, as noted by our opening speaker, it's pretty likely we'll be talking about this topic for several years to come. What I'd like to talk about today are the opportunities and challenges in distressed real estate. We're going to start from a very big picture perspective, macroeconomic view, and then we're going to drill down into commercial real estate specifics and talk about how the two relate. I like to start at the big picture because, frankly, the big picture matters a lot, and it matters more than ever in this space where political implications play a far greater role than perhaps any other portion of real estate. So what we're going to talk about, first we'll go over the capital markets. We're going to talk about the big three, which are the banks, the special servicers, and the government. And then I'm going to give everybody a little bit of a insight as to what we think might be coming from the government and the macroeconomic environment. Current market sentiment. We're in a very unusual market today, and it truly is a tale of two markets in a lot of different ways. It's a tale of two markets because right now, if one were to take a look at the sales of commercial real estate in the United States, and one were to take a look at the sales in Washington, D.C. of core office buildings, they would think that the market is fantastic. We are seeing cap rates being achieved on core real estate in D.C., Manhattan, San Francisco, certain markets in Boston that are at or close to peak value. Certainly the cap rates in multi-housing are even in excess of where they were at the peak. Pretty remarkable. That's the Dr. Jekyll side. The Mr. Hyde side is the distressed real estate. It's a very different market for distressed real estate, very choppy. There are certain portions of distressed real estate that are pricing very well. We'll talk about note sales, where in some cases we're getting prices for notes that are exceeding the value of the underlying real estate. Illogical, but happening. But nevertheless, that doesn't give a true picture because most of the distressed real estate that we're seeing, once you get into the secondary markets and with a heavy development component, you're seeing pricing that is very choppy and very poor. There's also a tale of two markets about what people think we should do. There are a tremendous camp out there of people who want to put more fiscal stimulus into the economy, but there's an equally strong camp of people who want to pull back. In the words of Ben Bernanke, the Fed chairman, we are truly living in unusually uncertain times. Staying on this theme of two different sides of the markets, there are people out there that have a very bullish perspective and those that have a very big perspective. And I'd like to talk about both of them because one can have a reasonable opinion on either side of this debate. The bulls in the market are saying the market has capitulated. We know that fundamentals are bad. We know that rents are dropping. We know that occupancies are maybe stabilizing. But, you know, we're at the bottom, and that's a good thing. And we're beginning a recovery, and we're seeing some evidence of that in multi-housing. Multi-housing seems to have already started to improve occupancy, started to improve rents. But there is a whole bear argument in the marketplace. Say, yes, we're at the bottom, and we're going to be there for a long time. Welcome to Japan. The Japan argument is very simple. We never allowed the banks to clear. We never allowed the banks to clear their assets because when we went in to save the banking system in 2008, rather than buying the bad assets off the banks, we put a bunch of cash in there. And by putting the cash in, the banks are better capitalized, and we may not clear these assets for a long time to come. The bulls in the market say, well, that's great, but American ingenuity is going to prevail as it always does. Out there in the marketplace, there's another Google, another Microsoft. American ingenuity has gotten us out of every recession and is going to get us out of this one. Well, the bears are saying we can't even build a tunnel to New Jersey right now. How are we going to build the next Google? So there are some very, very pessimistic folks out there. The bulls are saying, well, we may be having our troubles here in the United States, but at least the emerging markets are doing well, the so-called BRIC countries, Brazil, India, China. So we can invest over there and take that capital and bring it right back here to the United States. Well, the bears say, well, that's great. Things are going so well over there, they're taking all of our manufacturing jobs. So how are we going to recover if nobody here has a job? But the biggest debate of all is this one. The folks that want fiscal discipline in a low-tax environment versus the bears would say we need to put more fiscal stimulus or bust. You don't think this issue is important? As I'm speaking here at the podium today, they are literally rioting in the streets of France over this issue. The French government, the British government, the German government have all taken choice A, the fiscal discipline plan, and I can tell you it's not going over well with the public in those countries. Can that happen here? You bet. This is going to be the biggest debate of the next 10 years in this country. Jobs. Jobs are everything. It's as simple as that. Let's go back. Jobs are everything. Commercial real estate lags the job market by 6 to 12 months. Once we see an improvement in jobs, that's when we're probably going to see an improvement in rents and occupancies in commercial real estate, particularly in office, 6 to 12 months thereafter. The problem is that the jobs picture right now is difficult. We are hovering at or around 10% unemployment. That's when we're probably going to see an improvement in rents and occupancies in commercial real estate, particularly in office, 6 to 12 months thereafter. The problem is that the jobs picture right now is difficult. We are hovering at or around 10% unemployment. But there are other things going on in the job market that have a secular change that have occurred in the last several years. One of them is the number of manufacturing jobs. I put a picture of Rosie the Riveter up there to emphasize the point that the number of manufacturing jobs in the United States is almost the exact same number of manufacturing jobs that were in the United States in 1941. That was before the big buildup in World War II. The problem with that is how does that affect commercial real estate? Are we going to have to build more industrial sites? How is it going to affect office demand? Another thing to keep in mind is that we have the same number of private sector jobs today as we had in 1999. So we have an enormous hill to climb. And that doesn't even take into consideration underemployment of folks that are currently employed. So jobs are everything, and we have a long way to go to improve it. Sticking with the theme of those that are bullish, those that are bearish, the two sides of the market, I think nothing emphasizes this better than the Republicans versus the Democrats. I don't often talk about politics at these types of events, but politics really matters in distressed real estate because politics is going to determine what our plan is going forward, what type of additional fiscal stimulus or not we're going to see in the economy. Well, from the Republican perspective, the reason why there's a problem out there is because we just entered this new health care plan. What's it going to cost? We have all of these huge deficits. Are they going to raise my taxes? These are the kind of arguments that people are making. They say, well, because of that and because they don't like President Obama, they're not going to hire any new people. The Democrats have a very different perspective. They're like, well, government needs to spend because the consumer is broke because all home equity has been wiped out and business is holding back. And when all else fails, they'll also blame George Bush, who seems to be the gift that keeps on giving. But at least there's one thing that we have bipartisan support about. Let's blame the Chinese. Everybody's talking about today that the big problem we have is that the Chinese currency is artificially low. And if it just floated up to natural levels, everything would be better. Well, friends, the Chinese economy is 1/4 the size of the U.S. economy. Even if their exchange rate went to par value tomorrow, it would take a very long time for it to filter into our economy, and it wouldn't have that dramatic of an effect. But I have a different perspective on this, folks. Is it Barack Obama's fault? Is it George Bush's fault? Is it the Chinese fault? I don't think it's any of theirs fault. I'll tell you whose fault it is. It's Grandma's fault. And the reason why it's Grandma's fault is because we have tremendous unfunded Medicare obligations, Social Security obligations, and underfunded pension plans, which is going to make this the fight of the next 10 years in our broader economy. And you know what's a bigger problem? We don't have enough people to pay for it. This is what's coming in the United States. This line represents the number of workers in the United States economy as a ratio of the number of people in the U.S. over 65. Let me sum it up for you very simply. Today, there are 4 workers for everybody in the U.S. economy over 65 years old. In 10 years, there's going to be 3 workers. In 20 years, there's going to be 2.5 workers. So remember all those problems I just suggested to you regarding Social Security and underfunded pensions? They're bad, and it's going to get worse because we don't have as many people to pay for it. We're in the midst of a baby bust. Now, if one were to compare and contrast this very same slide to what's happening in Brazil, India, China, they have a tremendous rise in their populations coming over the next several years. This problem is going to confront us. It's a double whammy. We have a big problem today in underfunded pension plans, Medicare spending, and Social Security, and it's only going to get worse. Those countries don't have that problem, and they're growing. This affects everything. This affects the immigration debate. This is the single biggest problem we have facing us over the next 10 years. Capital markets overview. How does all of this affect commercial real estate? If you take a look at the chart up there, you could see that fundamentals in commercial real estate are weak. If you take a look at the various asset types, starting with office, you could see that at the end of the third quarter, office vacancy nationally was almost at the peak level of 17%. We're around 16%. Industrial is about the peak level. Retail is there. And multi-housing and hotels seem to be the 2 areas that have either capitulated. Multi-housing is by far the strongest asset type, and hotels seem to be getting a little bit better. But what this chart shows is, in addition to the fact that we are at or near peak levels of vacancy in all asset types other than multi-housing, is when we're going to get back to what we call our so-called natural rate. What is a natural rate? It's a fancy term for saying this is when you can raise rents again. You could start raising rents again in 2013 in office, 2015 in industrial, 2016 in retail. Think about that, folks. But multi-housing is already getting some pricing power today. So, in other words, fundamentals are weak, but at least in certain asset types, particularly multi-housing, they have bottomed and they are getting a little bit better. Now, if one were to take a look at this chart alone, they would say, wow, real estate's really hurting. Values must be terrible today, right? Well, wrong. This chart shows cap rates. And this is where cap rates are expected to go and where they are today across all the major asset types. In 2010, we have an average cap rate across all asset types other than hotel of around 7.5%. I will tell you this, it is a tale of 2 markets. Going back to my Jekyll and Hyde slide, you take the core deals in the best markets, we are getting cap rates today at approaching peak levels. We're getting cap rates with 5 handles on it for multi-housing, 6 handles on it for office, 6.5 handles for some of the best retail. Incredible pricing for the best real estate. But once again, it's a tale of 2 markets. It's a little bit false because there's actually very little real estate out there. And because of that, there's a supply-demand imbalance which is bidding up real estate. Let me give you one example. This is a 1999 K Street. This is a deal that Decca bought last year in Washington, D.C. in October of 2009. At the time, it was the highest, and actually still is the highest price ever paid for an office building in Washington, D.C. Paid $835 a foot and a 6.3 cap rate. A lot of people thought that Decca overpaid. They were crazy. What were they thinking? Well, guess what? If this asset were to hit the market today, I'm confident that there would be a 5 handle on the cap rate. And the reason why is there's very few Class A trophy assets in major markets, and the cost of debt was low then, and it's only gotten lower today. And it is expected to stay low for a very long time. Interest rates are going to keep cap rates low for an extended period. And assets like this, where people thought they were crazy paying a 6 cap and $800 a foot last year, if they retraded it today, they would get an even better price. Why is this happening? There is a wall of equity out there. This wall of equity didn't just start in the last couple of years while people were raising distressed funds or core funds, and by the way, that is part of it. This wall of equity started in about 2000, 2001. Everybody talks about the recession and says, you know, why is this different than the early 90s? And I'll talk about that a little bit too. But what I like to talk about is why is this different than the early 2000s? What happened in the early 2000s? In the early 2000s, we had the tech bubble. And then when you had the tech bubble, all of the pension funds and endowments who used to see commercial real estate as an alternative asset class started seeing it as a primary one. They started pouring money into commercial real estate because they felt there was safety and security in having a hard asset. So 2000 is when this wall of equity started, and it's continued to this day. The problem we have today and why we're seeing these high prices, because the wall of equity is chasing core deals like this little surfer guy over here. It's this much equity for this number of deals, you're going to see cap rate compression in the major markets because of it. The number of deals that are actually getting done. Let's start with the good news. The good news is that we are seeing an incredible increase from last year. We're up 70% in office, 50% in multi-housing, 180% in hotels. This is pretty good news, right? Well, let's see just how relative that good news is. If you take a look at all the deals being done in the marketplace today and you were to annualize it, we would have total deal volume in 2010 of about $82 billion. That's slightly more than the total deal volume of all trades in 2001. It's nowhere near the peak number of trades that occurred in 2006, 2007 between $375 and $500 billion. So we've got a long way to go to get back to an equilibrium rate of trades. And by the way, just the equilibrium rate of trade is probably somewhere between 2004 and 2005. We would expect that we're going to double volume next year, not to get quite to the $200 billion level, but we're optimistic that we are going to get to a level closer to 2004 levels next year. The big three. We're talking about distressed real estate, so we've got to talk about the biggest players in the market. The biggest players in the market are the banks, the special servicers, and the government. And each one of them is playing an important role, and each one of them takes a very different slant on how they are trying to dispose of real estate and how they're trying to, in the case of the government, try to improve the market overall. The U.S. distressed market. In summary, based upon RCA's data, there's about $350 billion of troubled deals out there. Just to give everybody a sense of scale, the entire U.S. commercial real estate debt market is about $3.5 trillion. So this represents about 10% of the U.S. commercial real estate market is in some level of distress. The one bubble I'd like to draw your attention to here is this bubble here at the bottom right, which is the level of lender REO. Only about $35 billion of REO, which is a very small piece of the overall puzzle. So about 10% of all distressed real estate is REO. And remember, this represents about 1% of all real estate in the United States. So very small amount of REO. You know, why is that? Everybody thought that we were going to have a flood of REO like we did in the early 90s. Well, this is what's going on, folks. The banks. Not all banks are created equal, and when you're dealing with the banks, you've got to first understand the strength of their balance sheet. The banks with the strongest balance sheets, and there's no mystery who these banks are. These are the big banks. These are the Wells Fargos, the JP Morgans, the Bank of America of the world. They have the greatest flexibility both to sell REO, to sell notes, and to do workouts with you. Some of these smaller regional banks, particularly those banks that still haven't given TARP money back, you do realize there are some banks out there like SunTrust, Fifth Third, Synovus, they still haven't given their TARP money back yet. Banks like that have far less flexibility to work deals out or to sell REO or notes. So the first thing you need to do is say, you know, I want to get a deal from Bank of America. You need to know, well, is this a well-capitalized bank? Yeah, it is. And how do I get the deal from these guys? Just a couple of tips. If you are an existing borrower of one of these banks and the bank is selling a note, you've got a better shot at getting a note than somebody else. That's a tip that a lot of banks will give you. So issue number one, know your counterparty. You've got to know if it's a well-capitalized bank. Number two, if the bank was recently purchased pursuant to a loss share agreement, you've got to know that. Because if you want to do a workout transaction with a bank that was recently purchased pursuant to a loss share agreement, you have to deal not just with the bank, but with the FDIC, which is their partner. So it's very complicated, very difficult to get a deal done with banks that were purchased pursuant to a loss share agreement. But all the banks look at the world the same basic way. There are four choices when a bank has a bad deal on its balance sheet. The four basic choices are work it out, short sale, note sale, REO. And their preference really does fall in that order. Their first choice is to work the deal out. A couple of basic reasons. Number one, the regulators are telling them to do that. The regulators came out with a white paper last October that said, look, you got a decent borrower in a decent market, work the deal out. But the other reasons why they're working these deals out is because, as I suggested a couple of slides ago with the wall of equity, things are getting better in terms of value. So all of the pejorative things we heard last year about kicking the can down the road, pretend to extend, well, guess what? The banks were right. By holding these assets longer, they were able to protect their balance sheets, and they are capturing more value for that. But the one area that I think is most interesting is what's happening in notes. Remember when I suggested there are four choices. You got workouts, you got short sales, you got note sales, you got REO sales. Historically, there used to be a tremendous value difference between notes and REO. People would buy the note and say, gee, you know, I'll go through the time, effort, energy, expense, and risk of buying the note, foreclosing out the borrower, and taking title. And that's the way the business worked in the early 90s. And there are billions and billions of dollars of funds that were raised, and I'm sure some of you in this room today have funds that have bought, that are buying notes today under the same basic premise of the value differential between a note and REO. Well, guess what, folks? Remember that wall of equity I showed you a couple slides ago? That is the same wall of equity chasing notes. For the best notes in the better markets, we are seeing values achieved today for individual asset trades, in some cases that meet or exceed the value of the underlying real estate. Think about that, folks. That's not logical, but it's happening because there's so much equity chasing so few deals. Now, I don't want to mislead you. That's for the best assets in the best market. Going back to my first slide, talking about the Jekyll and Hyde of the market, there are still some very troubled deals out there. And for those deals, we are not getting values that are exceeding the value of the notes. Take land deals, for example. Land deals are still very troubled. We are still seeing prices at 10 to 20 cents on the dollar. Now, I note there actually was a brief spike in the value of land in the United States in the first quarter of this year. In the first quarter of this year, the national home builders were very optimistic about the economy, and they were buying up all of the land that was in some of the better markets. We were seeing prices at 50 cents on the dollar. That has now fallen off the planet again because the home builders are not as optimistic anymore, and we're having a very difficult time trading land deals. The second of the big three, the special servicers. At this point, everybody knows what a special servicer is. These are the guys that manage troubled CMBS loans that are either in or near default. Couple of things that recently have been occurring with special servicers. First of all, they're swamped. They're swamped so badly that for smaller deals, it's much more difficult to work them out than for larger deals. Why is that? The workout process is basically the same for a $5 million deal as it is for a $100 million deal. Well, it's true, but they simply don't have the people power to be able to manage all those. So if you speak to the servicers, they will tell you you will get much better attention to work out a large deal than they will for a smaller deal. As a matter of fact, for some of the smaller deals, most of the major servicers are in the process today of packaging these deals and selling them as notes because of the administrative burden involved with working out the smaller transactions. But there's another very, very interesting trend which has been occurring in the last couple of months. Several of the largest servicers in the country have either been sold or recapitalized by strategic buyers. CW Capital, just bought by Fortress. C3, bought by a group called Island Capital. L&R was just recapitalized by a variety of strategic buyers. Berkadia was bought by a strategic buyer about a year ago. What does it mean? Well, let me tell you, we're not sure yet, but here's a couple things to keep in mind. Strategic buyers, under the terms of the fund documents, are allowed to buy assets out of the trust at fair market value. They've got first dibs at the assets. And what is that going to mean to deal flow going forward? What is that going to mean to workout discussions? What is that going to mean to which assets they take REO? Unclear. But that is the elephant sitting in the corner of the room right now when strategic buyers buy these servicers. It's going to change the way we have been doing business with servicers over the last several years, because now there's another party in the room that may want the asset for themselves. The government, the biggest of the big three, and by far the most important party in this whole equation. Let's just recap for a second some of the good and the bad that the government did in this crisis. And the two major programs that affected commercial real estate were TARP and TALF. And I'm sure you're all tired of the acronyms, but just the summary of TARP and TALF is good and bad. The good is TALF. TALF was a really good program. What TALF did was allowed buyers to buy the AAA slices of legacy CMBS securities using a tremendous amount of very low-cost government leverage. What happened because of that? Because of TALF, the CMBS market can now operate again because AAA spreads have come in so far that we are now seeing more CMBS deals being done, certainly this year over last year. It is by no means robust, folks. I think that at this point we're at about $8 billion of total deal volume in 2010, when in 2007 we were at $200 billion. So a long way to go to the peak, but better than the $1 to $2 billion that was done all of last year. So things are getting better, and you can thank the government and TALF for that. Where the government had a mixed report is TARP. What TARP was supposed to do, the Troubled Asset Relief Program, was to buy the bad assets off the balance sheets of the banks and then give banks more cash so that they could then lend to you guys. Well, the day that TARP was passed, the day, in October of 2008, Hank Paulson, the Secretary of the Treasury, knew TARP wasn't going to work on that day. And he said, you know what, we're going to change from a buying program to an investing program. And he invested in dozens of major American banks. And the good news is he saved a lot of them. The bad news is that he saved a lot of them. By saving all of these banks, the market has never cleared. And until the market clears these bad assets, it's going to extend the problem we have today, particularly for these smaller assets in the secondary markets, where there's still no pure price discovery. But what is the government doing today? The major player in the government today is the FDIC. And the FDIC is selling assets in three basic ways. They are selling assets by selling entire banks. Their whole bank program, been very successful, so traded dozens of banks that way. The so-called structured sale program, and then individual asset sales. There's good news and bad news about each one of these. The good news about the whole loan program and the structured sales program is they're selling big blocks of assets all in one shot, in high volumes of deals. The bad news is this. On the whole loan program, because of the way they structure their partnership with the new banks, it is very difficult to sell the assets out of a whole bank transaction. Some people say it takes up to 6 years to clear the assets that were bought in whole loan transactions, whole bank transactions, because of the restrictions the FDIC has placed on it. So the good news, a lot of volume. The bad news is, good luck getting an individual deal out of it. The better news is the structured sales program. The structured sales program is one where the FDIC has already stripped the assets out of the banks and then sells them through one of the brokers on Wall Street primarily to private equity firms. And they've done about 13, 15 of these deals so far, and they've gone pretty well. They've sold large loan pools ranging in size from about $300 million on the low end to well over $1 billion on the high end. And a lot of the well-known private equity funds have been buying these. Firms like Colony and Starwood Capital and Square Mile have been buying these large pools. And the good news is the FDIC is going to do more of those kind of deals going forward. Why? Because it lets them clear large volumes of deals very quickly. The third category of deals that is out there are individual asset sales by the FDIC, and they're doing that in two ways. One is the sale of notes, wherein there are several vendors that are selling individual notes. These include groups like DebtX and Mission Capital and Eastil. And then there are groups selling REO, which includes C.B. Richard Ellis, it includes Prescient, includes some other firms as well. The problem is this. Much like the special servicers being overburdened, the government is overburdened. Right now, for administrative reasons, The FDIC is likely to do far fewer individual asset sales going forward and far more of the structured sales programs going forward, so they'll clear more assets. But, you know, what do you say? I'm a small investor. What do I do? How do I get involved in the game? Well, the good news is the FDIC hasn't forgotten about you either. And so what the FDIC is going to be doing is they're starting a new securitization program to basically sell smaller shares of these larger pools to smaller investors. So the FDIC is being creative in ways to clear large blocks of assets. Unfortunately, they've shut down, if not shut down completely, they've slowed down the individual asset sales, which is very disappointing for the marketplace because it doesn't allow for price discovery. A couple of deal structures we're seeing out there today. The structured sales program, I just talked about this. As I mentioned, 13 or 14 of these deals have been done. A lot of people are involved in the bidding process. And you know who can be involved in this bidding process? Any single one of you in this room. You put up 250 grand, you get qualified for the FDIC, and you can bid on any one of these pools. And if you think that, well, you know, these pools are anywhere from $125 to $250 million, how am I going to come up with that kind of money? Well, there's a couple pieces of good news here. First, the FDIC provides a tremendous amount of leverage and a tremendous amount of equity. So if we're on a $125 million deal, you may only have to put up 10% of that. Now, you say, I don't have 12 million bucks. The FDIC also has programs in place for smaller contractors to team up with bigger contractors to allow them to get involved in the process. So there's a lot of ways to get involved in this process. And if you want to know what's going on in the marketplace, you know, and you have 250K, get involved, get in the bidding process. You'll see the deals that are coming out there. One of the points that's on here is the third point. There was bidder fatigue in the last round. Part of the reason why the deals are smaller now, 125 to 250 million, versus where they were, which was 300 million to over $1 billion, is that people want smaller deals. I think that a lot of the large deal velocity is out. And the last point I'll make is something I said very quickly, is that the FDIC is now going to start a new securitized program to allow even smaller investors to buy pieces of these larger pools. A couple other deal structures we're seeing quite a lot of. REO sales. The deal on the left is the Watergate Hotel. We sold the Watergate Hotel for PB Capital back in June. Watergate Hotel was one of the higher profile REO trades in the United States. And much like the note deals that are getting bid up if they're better assets in the better markets, the Watergate Hotel also got tremendous interest. That's the good news. The bad news, there aren't that many REO deals that are like the Watergate Hotel. Most of the REO deals tend to be disproportionately land in secondary markets, and those deals are having a very difficult time being traded. So some REO deals trade well, like the high-profile ones, but the smaller ones are still struggling in the marketplace. Note sales. Everybody here is talking about note sales, as I suggested. Some of you probably have funds out there that are looking to buy notes. And you see in the marketplace, there's a ton of notes. We're one of the largest note dealers in the country. DebtX is here. Mission Capital is here. So a lot of my friends at these different businesses that are in this room, and they're selling a ton of notes. And you say, wow, notes are really clearing. For every note you see being sold by us, by Mission, by DebtX, by Eastil, there's probably 3 times that amount that are being sold quietly by the banks to large private equity firms that you never hear about, you never read about. The banks don't want you to know. They are selling a lot more notes than you know what's happening in the marketplace today. So keep that in mind. Another structure we're seeing in the marketplace today, UCC foreclosures. UCC foreclosures is something we're seeing a tremendous rise of. And what a UCC foreclosure is when a mezzanine holder takes out the equity of a deal and keeps the senior debt in place. The highest profile UCC foreclosure took place with the John Hancock Tower in Boston, where the Normandy Partners, which was one of the mezz lenders, took out the equity but kept the senior debt in place. What was beautiful about this deal is when they took out the equity, the asset was valued at $670 million this past spring. Well, fast forward to 2 weeks ago. They just sold this asset for $930 million to Boston Properties. So they foreclosed out the equity at $670 million valuation. 6 months later, $930 million. Bankruptcy sales. Seeing quite a few bankruptcy sales out there. And if you want to get involved in the process of the bigger deals, bankruptcy is the name of the game. We would suggest to you that the majority of the big, complex deals that are going to come to market are going to come in the bankruptcy context. And you can get involved in these deals. You can show up in the bankruptcy court, and when they have auctions, you can bid on these. And the good news is that in a lot of these situations, because values seem to be improving, you can often outbid the mezzanine lender, which are typically winning these situations. You can get involved by providing debtor in possession financing. You can get involved by becoming a stalking horse. There's a lot of ways to get involved here, but track what's going on in the bankruptcy space. So what's coming, folks? Big picture, when the government got involved, they had two choices. They could save the banks or they could save the market. Some people would say that by saving the banks, they did save the market. Wrong. They saved the banks and they slowed the market. The banks never cleared because TARP put too much money into the banks and gave them limited incentive to sell the assets into the marketplace. TARP has not worked in terms of reinvigorating the market, and TALF has been a limited success. Cheap capital is a double-edged sword. Everybody in real estate loves low interest rates, right? They're the greatest thing in the world. I can refinance my asset. If I have a multi-housing deal in a stabilized market today, you could probably get 3.5% from Fannie and Freddie. If you got a larger asset in a major market, an insurance company will price inside of it. That's great, right? Well, it also is the same cost of capital for the banks that are holding these assets. And if a bank has a cost of capital that's next to zero, what are they going to do? Nothing. Because interest rates are so low, banks have limited incentive to sell the assets off their balance sheet. So where is the tsunami? It's not coming anytime soon because the FDIC is overburdened. They're going to be selling a lot of deals in pools. Note sales are going to be the preferred means of selling stuff, but as I suggested, probably 3 out of the 4 deals that are being done quietly. You're not even seeing them. A couple of areas of opportunity. One area of opportunity that I didn't mention are secondary market trades by private equity firms. So basically a private equity firm that has bought some of these structured sales pools. Those are the folks that you're probably going to see a material pickup in deal volume as these private equity firms are selling deals that they recently purchased. So what's the solution? As I suggested to you earlier, there's 2 schools of thought on this. There is no one right answer. Should we put in more stimulus dollars? Should we keep home foreclosures going, or should we stop because the paperwork was wrong? Should we raise interest rates? I may be the only guy in commercial real estate who thinks that interest rates are too low and they got to get up there soon, or we're going to be in this for a very long time. Should we increase regulation so people stop making mistakes? Or should we do what every politician wants to do, trade war with China? The easiest solution is always to blame somebody else. Do we need a genius to help us? Alan Greenspan, noted by most folks as one of the smartest guys around, perhaps the greatest economist of our time. He's also the same guy in 2005 that said, if we pull back on Fannie and Freddie, it will have bad effects on the home mortgage market. He's also the same guy who said that he didn't understand how individuals could take risks that could jeopardize institutions. This is the smartest guy in the room, and he said that. So what do we need? I'll tell you something that everybody in this room has. What we need is more than anything else is simple. We need courage. And I'll tell you what courage is, folks. We need courage from our political class. We need them to make decisions for what's good for the country and not what's good to get them reelected. We need courage on our corporate boards of directors to say no. I don't understand what an Alt-A mortgage is. I don't understand a credit default swap, and we're not doing this deal until you explain it to me. We need courage from bankers to mark their assets at true market on their books and then sell them at the marketplace at the market clearing price. But most importantly, we need courage from each of you. We need each of you to keep the faith, to know things are getting better, to stay optimistic, because optimism is the most important thing we have. Thank you very much.